Coronavirus poses tough challenge for economic policymakers. Washington, AP. The fast-moving coronavirus isn't just confounding health officials. It's also bedeviling policymakers and central bankers who are struggling to assess the economic damage from an outbreak that's reached 37 countries and territories, infected 80,000 people and killed 2,700 worldwide. They don't know where or how fast the virus will spread. They can't draw on clear precedents to consider what to do. And the tools they normally use to fight economic slumps, interest rate cuts, government spending hikes and tax relief, either might not work very well, lack broad support or carry their own risks. If they overreact, policymakers can cause self-defeating panic. Yet if they respond too slowly or timidly, they risk having the economic damage deepen and spread. Stock markets tumbled and bond yields sank Tuesday for a second day on rising fears that COVID-19 and the quarantines being imposed to fight it are obstructing global supply chains and could derail corporate earnings and the global economy. The Dow Jones Industrial plunged 878 points -3%, after plummeting more than 1,000 points Monday, the sharpest drop in 2 years. This outbreak will have a significant effect on worldwide demand for tourism, travel, and other services, while the supply chain disruptions and increased uncertainty will hurt current production as well as investment, said Eswar Prasad, a Cornell University economist. The timing of the outbreak is especially unfortunate. Europe and Japan are flirting with recession while China and India had been losing growth momentum. Mark Zandi, chief economist at Moody's Analytics, suggested that the European Central Bank has little ability to counteract a recession. It has cut its benchmark rate into negative territory, to -0.5%, and is already buying government bonds to try to further lower longer-term rates. What is the policy response in Europe? Zandi asked. There is none. With so many other economies overseas struggling, the US would likely suffer a hit just from the overseas slowdown, he said. Catherine Mann, chief economist at Citi, said the financial services giant has cut its forecast for global economic growth this year to 2.5%, the weakest pace since the Great Recession more than a decade ago. When the virus began grabbing headlines last month, most economists were relatively sanguine about the economic damage it could cause. They predicted a repeat of what happened when the SARS outbreak hit China and its neighbors in 2003, a short-lived blow to economic output, followed by a relatively quick rebound. But the virus has proved virulent and fast-moving. No one expected the virus to slam countries as far-flung as Italy and South Korea. And the quarantines and lockdowns that governments have imposed to try to stop the outbreak have. For more on this story, visit the news article link.